Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. One of the biggest stories in recent weeks has been the shift in commodity prices. In many cases, the record prices we saw for hard and soft commodities have pretty much reversed, with traders worried about recessions in the US and Europe and China not hitting its growth targets. Oil, copper, gold, silver, natural gas, palm oil, lumber, they've all come down, some more sharply than others. The big exception really is coal, largely thanks to the war in Ukraine and the energy crisis. Vivek Dhar is the Director of Mining and Energy Commodities Research at Commonwealth Bank. Vivek, welcome back to Fear and Greed.
Oh, thank you.
It's been quite the reversal the last month or so for commodities.
That's very much true. In fact, from the beginning of June, we've seen prices really start correcting downwards and quite quickly. I'd say base metals and oil have been really at the center of it from the mining and energy space. But it's something that has certainly shifted very quickly and well ahead of, I think, market expectations.
Before we jump in, and we'll start with oil in a moment, but kind of the macro picture here, is it about fears of a recession in the US and China perhaps not doing quite what we'd hoped it would do, and Europe, which is in probably a worse shape than the US? Are they the macro background, is it?
Look, I would say very much it's now centering around demand concerns. Like the situation on the demand side was already quite bleak for emerging and developing economies coming out of COVID and then facing a food and energy crisis. But where the market started turning particularly was when advanced economies, particularly the US, started considering that a recession was a possibility. And that's really where we've started seeing the correction. But more broadly, this has now been encapsulated with a view that global growth concerns have risen sharply.
Okay, so let's talk about oil. Brent crude and West Texas Intermediate, they've both sort of been beyond $120. They're back down, around the $100 mark, a little bit more than that. It seems they've dropped back, but taken a bit of a breather. They've been in where they are now for a week or so. What's the outlook for oil and hence for my petrol price?
Well, it's interesting you actually say that, because the dynamics governing oil and petrol prices has actually changed this year. So oil is very much connected to the financial market. And so this sell-off that we've seen, it has hit oil quite hard near the beginning of June. And this, for us was due to, of course, the repricing on demand concerns. But the refined product side actually started falling by late June. So by June 23, actually, it started falling. Now, when we talk about refined products, we are talking about petrol, diesel. These are the prices that hit the real economy. And it was this aspect on the pricing product side, which has actually started coming off quite a bit. So it's down. You talk about diesel, which is priced out of Singapore, which affects Australia. That's down 15 to 20% as we talk. And that's something that is going to flow through and help the consumer. And that's something that everyone should notice hopefully soon. But, keep in mind that the excise will come back in Australia. So you may get it for a little bit, then you may lose it. But it's something that at least we're seeing the refined product prices come off.
Okay, sorry, Vivek, just explain to me, why was it that the connection between oil prices and refined prices changed a month ago or so?
Sure. So look, when it comes to refined product prices, the change actually started when the Ukraine war began. So firstly, Russia accounts for about 6.5% of global diesel supply. And when we talk about their refineries, they've been operating at about 70%. So 30% has been idle in May. And so, we've seen production not hit the market because there's just been a lack of spare capacity. And the Ukraine war really started it, and Russia is center in that. But even preceding the Ukraine war, we actually saw global refining capacity contract for the first time in 3 decades in 2021. And the reason why we saw a net contraction was we saw a lot of US and European refineries take the opportunity to actually close up because of low margins during COVID-19. Now, that was one aspect that led to very low spare capacity coming into 2022. But the other major market development was a lot of the refined capacity that's been added to the market has really come from the Middle East and China. And Chinese exports of refined products has been quite constricted. So in May, it fell to a 7-year low for diesel. And really that was because ever since their power crisis at the end of last year, they've actually put limits on energy intensive exports. So that has meant that this spare capacity in this market has been very, very limited. And so you talk about refining margins, it's gone from about historically an average of about $10 a barrel, lifted to a high of $60 a barrel, and is now about 45 a barrel. So we've seen an adjustment on that side, but it's meant that we've seen refined product prices head up much higher than what oil did, despite historically those being connected before 2022.
Okay, but the outlook though, as that more capacity comes on, is good. So, I mean, sort of the bottom line for many of us is that petrol prices theoretically, park the excise tax issue, are more likely to fall than rise.
That's correct. So what was really observable in the market was when we started seeing oil prices correct in early June, our concern was like, this won't really translate through to the real economy unless we see product prices follow. And it only started following by late June. And that's really why we're now thinking that, yes, this is a story where demand is weakening because we're seeing refined product prices fall. And that is something that will translate through to the end consumer. That's right.
Stay with me, Vivek. We'll be back in a minute. My guest this morning is Vivek Dhar, mining and energy economist at Commonwealth Bank. Let's move on to gold, which is traditionally a safe haven. But I must say, gold hasn't acted that way. I mean, the US dollar seems to be the safe haven now more than gold.
That's right. So, gold has been one where everyone expected that if global growth concerns rise, you'll have this safe haven demand flow. But historically, when we look at safe haven, we see US dollar as almost a tier 1 safe haven asset, and gold is a tier 2 safe haven asset. And this is exactly what's played out in terms of, the US dollar has rallied quite significantly, and that has actually pressed on commodity prices generally, but gold in particular. The other part that has actually weighed on gold as well is a fall in US 10-year inflation expectations. What changed in June was the fact that the Fed, after that 75 basis point rise, they really felt that the Fed is going to contain inflation, that we are going to see the Fed do what it takes. And that has actually weighed on that long-term inflation expectations in the US. And that is something that has also pressed on gold. So there's been two factors, but that's the reason why we're in the 1700s when we talk about gold prices.
Okay, so oil, gold, coal, that seems to be the exception to the rule. And I mean, is that because of the war in Ukraine? Because prices have held up.
That's right. And it's not just thermal coal, though. Keep in mind that LNG spot prices have also jumped. So we've actually seen two commodities which are very much linked to the Ukraine conflict stay up. And, thermal coal, 16% of traded supply comes from Russia. So it's very leveraged to what's happening from the Ukraine war and reduced demand from advanced economies. But it's actually more what's going on with gas that is keeping both gas and thermal coal prices elevated. What we've seen from Russia over the last couple of months is they are reducing their gas flows into Germany. And that has had the effect of boosting European gas prices, the regional price. And that's led to higher LNG spot prices in North Asia. And that in turn has helped keep thermal coal prices up because, the substitution between gas power generation and thermal coal generation has meant that both those commodities have been well bid in the last couple of months. So, that has been, counter to what we've seen in other commodities, but certainly LNG spot prices and thermal coal prices have held up very well.
Okay, now we are having a bit of a run through the periodic table here, and there are just a couple of others which I want to mention, which are very specific to Australia. The lithium metals, not the lithium metals, the battery metals, which of course includes lithium. They certainly seem to have come off the boil somewhat. They're not kind of trading where they were a few months ago.
That's right. Look, they've come off, but they're still not close to where they were a year ago. Keep in mind that this was a commodity that lifted, 8 to 9 times higher just a few months ago. So it's certainly been a commodity that has been very, very hot. And so, there will be some moderation. That increase was not sustainable. But when we talk about lithium and battery metals generally, we may see prices come off because of a cyclical downturn as markets price in recession fears. But keep in mind that the incentives to go down, say, electric vehicles, is something that is likely going to stay elevated over the next few years. We talked about refined products, we talked about diesel and petrol. The expectation before the Ukraine war was that we'd hit tipping points to switch from internal combustion engines to EVs as early as 2023. If anything, that has moved earlier. And that's really going to drive that battery metal demand story for the rest of this decade. And you may see a cyclical fall, but when we talk about that 5-year demand picture and even 10-year, it's looking very positive just given that transition.
Okay. And then the other one I just have to mention, iron ore, because of course, well, until last month, it was the largest export out of Australia. Coal took that mantle last month. But, over many years, iron ore has been our biggest export. What's happening there?
Sure. So with iron ore, it's still a very China-centric story. So when we talk about what has driven the price reduction, it's actually been a reframing of, I guess, the demand equation from instead of looking at the future and expecting infrastructure stimulus to save the day for iron ore prices, the market actually looked ahead and said, look, this COVID zero policy is going to stay with us. We're not sure whether this infrastructure stimulus will save the day. Let's start pricing in current fundamentals in the steel market in China. And as soon as that happened, we saw prices correct. And that is really what has happened because all the signals in China's current steel market point at oversupply. So you look at your steel stockpiles, you look at negative margins. It's a very telling story that the steel sector has built up a lot of production in anticipation for future demand. And as that has slowly been addressed, that has been the major force down on iron ore prices in the last few weeks.
Vivek, thank you for talking to Fear and Greed.
Thank you.
That was Vivek Dhar, Director of Mining and Energy Commodities Research at Commonwealth Bank. This is a Fear and Greed daily interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.